Hey guys, thanks for joining me on this first AMA of 2026. Hope everybody had a great holiday and you're ready to get back to work. This one's going to be an outlook for the next couple of years and where rent to own fits with a high market rate, or sorry, high rate market. So right now, comment Outlook if you'd like me to send you a PDF of my 25-26 Outlook. You know, it's kind of this is going to be what the market is going to look like in the next or how market affects rent to own in the next 12 to 24 months. Rates are sticky, inventory is tight, banks are strict right now, but this is actually the best rent to own environment we've been in a long time. And when I scheduled this thing, Trump had not opened his mouth yet about trying to eliminate institutional buyers from buying residential properties and renting them out. So that kind of adds to this whole market. Affordability is worse than ever right now. We had, after COVID and all this inflation that we've had over the past 5 years, all these prices are still high and they're staying high. A lot of listings, a lot of sellers are just accustomed to that market and they're refusing to drop their prices. And so they're just kind of staying there and the prices are holding high. And then you've got buyers coming in, and buyers are wanting a deal. They're looking at all this inventory on market. They're wanting a deal and they're just not willing to pay the higher prices. Occasionally you do have one though, and it keeps everybody's hopes high, and prices are just staying high. Bank approvals are down. All these banks lived through 2008 and they theoretically learned from their mistakes. They see the market tightening up, and so they're reducing their loan to value on loans. They're increasing their debt to income ratio requirements. They're requiring more qualified buyers, higher credit scores. There is some talk of legislation to lower the minimum credit score for Fannie Mae and Freddie Mac, but I've not seen any direct relationship to that affecting the market. So these approvals are down, and banks are just expecting higher quality buyers before they'll make a loan. And homeowner demand has just not moved. Homeowners, like I said before, are still expecting to get their premium price for their properties, and so the market is just kind of a standstill. So then we have the missing middle is the fastest growing buyer pool. You've got folks that can't quite qualify for a mortgage, but they can afford to buy a house. This is the best time to have folks that have reasonably good credit, reasonable assets behind them, reasonable income, but still can't qualify for a loan. And these are the folks that we go for. And this is why RTO, rent to own, fills that gap. Rent to own is built for folks that are just on the edge, just on the cusp of being able to qualify for a mortgage. These are folks in today's market, today's climate. These are folks that would have qualified for a mortgage, 2 years ago with their exact same income, exact same debt to income ratio, but they're just not able to qualify right now. And so these are the folks that we're really targeting in the rent to own. They're safe bets. They're tenants that pay their rent on time every month. They don't destroy the property, and they're going to buy the property in the next couple of years anyways. This is exactly what we go for. So, like I said, comment Outlook if you'd like me to send you a PDF of the next couple of years Outlook. If you'd like me to give you a personal breakdown based on your investment goals, DM call and we can set up a time that we can discuss it. Now I'll open up to a few questions. All right. What factors do you think are contributing to this worse than ever housing affordability right now? I think I don't believe that it has anything to do with institutional buyers. I don't believe that there's I don't believe that they make enough of a percentage of the available housing um, to make that big of a dent. I do believe that it's inflation. You've got somebody who's had the same job for the last 5 years. Their boss can only afford to give them so much of a raise each year, despite the fact that costs are astronomical. Some costs, the cost of building has probably gone up by 20-30% in the past 5 years, but income has only gone up by 10-15% in the past 5 years. Then you've got the cost of groceries, the cost of everything has gone up significantly, and all that affects the value of real estate. So the value of real estate is just sky high, and it's the salaries have not kept up with it, and so you see constant talk of the need for affordable housing. The problem is that lumber and labor and everything else is too expensive. So it's almost impossible to build affordable housing without some sort of government subsidy. That's a whole nother subject. What do you mean by the missing middle? So the missing middle is that's folks who can't quite afford a single family home. They can't quite afford the entry level home price. But there's just not enough. There's not enough affordable housing like condos, townhouses, manufactured homes, modular homes. There's not quite enough of them to meet the demand, and so these folks are stuck in the middle where they can't quite afford to buy a house, but their income and their assets and their credit scores all show that they can afford a payment, just not the payments that are available with single family homes. So these are the folks that are kind of, like we say, stuck in the middle. And these are the folks that we really go for. So how exactly does your rent to own model fill a gap no one else is solving? So with the missing middle, with the folks that have good enough credit scores to have been able to qualify and good enough income to be able to qualify for a loan 5 years ago, 2 years ago, 3 years ago, but can't quite qualify for a loan today. Those are the folks that we're helping. There's nobody else. There might be other individual rent to own investors or seller financing investors and all that stuff, kind of targeting this on a one-off basis. But I'm the only one that I know of that this is their primary model and primary strategy. Um, there's nowhere you can go that is helping those folks that don't want to rent anymore. They can't afford a mortgage, but banks just won't give them one. These folks will be able to afford a mortgage in the next few years, just not right this minute. All right, the missing middle demographic. Why do you think they're becoming the fastest growing buyer pool for housing? I believe that because of the missing middle demographic is growing. So you've got 330 million people in the United States, and 5 years ago, maybe 10% of those were in the missing middle. But as these housing prices increase and the banks get more strict, suddenly you have a higher percentage of those folks that just can't afford a home. So I don't know any numbers off the top of my head. I can't say it's increased from 10% to 15% or anything like that. But I can say that it's very obvious that we've had a significant increase in housing prices without a direct relationship to the increase in wages. And so the housing affordability gap has just gotten bigger, and the number of people who still have good income and good credit but cannot quite afford a mortgage, that number is just increasing every day. All right, I'll give a few more seconds in case somebody's typing. Oh, here we go. Looking ahead, what's the single biggest risk factor for the rent to own model in the next 12 to 24 months, and how's it being managed? This is a good question. I always tell folks that um, our risks are mitigated but not eliminated. Our biggest risks are based on individual tenant buyers. And so the individual tenant buyer, if we have a bad economy, something happens and they lose their job, we are set up so that we, because we distribute our risk among multiple properties, if any one buyer loses their job, they are not they're not going to hurt our monthly income, not significantly. Uh, if several do, or if a high percentage do fall upon hard times, we've got their down payments, we've got equity in the property. It gives us the opportunity to sell on market. Even if the market is going down, we still have enough equity in these properties to sell them and be able to recoup our losses from that particular tenant. But across the board, these individual tenants, having a down payment and having equity in the property is a huge risk reducer, and that's how we manage the risk. This down payment and pre-qualifying the tenants is our biggest tool. All right, I believe that's it. It's good to see you guys. Thanks for being here. These AMAs are meant to simplify your decision making. I look forward to seeing you at the next one.